So we've just had the latest announcement from the Bank of England on the interest rate, the base rate of interest, which influences so much out there, our savings, our mortgages, our borrowing, all these kind of things. And as anticipated, there has been yet another hike. And this is a biggie, the largest single increase since 1989. It's jumped up from 2.25% to 3%. That's a 0.75 percentage point increase. Really, really, really big one there. And if you can look at then over the last year, the interest rate started increasing in December of 2021. So we're almost a whole year around, 11 months in, we've seen a jump of 2.9% from 0.1% to 3%. That is, as you can tell, big. Although our rate is still relatively low compared to where we were prior to the crash in 2008, this is still much, much higher than we've had since then. And this is going to be a lot of, we've been telling you this every 6 weeks, every time there's one of these announcements. This is going to have quite an impact on so much of our finances. Before I get into how this will impact your savings and your mortgages and other borrowing and things like that, it's worth just telling you a little bit more about today's announcement, exactly how that decision came about and some of the other kind of assumptions that the Bank of England are using to base that decision to make that increase. So the vote this time, there are 9 people on the Monetary Committee, the Monetary Policy Committee, who decide on this. And the majority, whoever, the biggest sort of chunk of the vote, that's what happens. This one was quite a comprehensive in favour of such a large increase. 7 out of the 9 members wanted that increase to 3%. One wanted a smaller increase to 2.75% and one wanted a smaller increase to 2.5%. So you can see the momentum there. They were generally in agreement that this is what needed to be done, such a large increase. Now, if we backpedal a little bit, actually, this is smaller than what some people had been predicting. When we had that crazy mini budget and all the chaos that ensued from it, when was that? The end of September, wasn't it? It feels like such a long time ago, but it was just only really recently. At some point, there were people thinking maybe the Bank of England would have to increase this time by 1.5 percentage points. That would have been massive. Obviously, things are kind of backtracked a little bit. There's a little bit more stability. Obviously, still a lot of people still things are bad, but I guess we should be thankful that it wasn't such a big increase. But still, that's where we are. That was it. 7 people voted and 2 people wanted still increases, but smaller increases. And the reason they're kind of going for this is because basically they want to try and bring down the rate of inflation. The idea is that if you have a higher interest rate, you're less likely to spend, you're more likely to save, and therefore that will kind of influence prices out there. They are anticipating that inflation, the next figures we get, which will be for October, so we'll get them in the next few weeks, will be around 11%, which will be absolutely high, massive, much, much higher than we've had before, and maybe stay around that 11 to 10% until the start of next year. The Bank of England is then saying it expects inflation to start dropping down in 2024. Now, some of this is just simple maths because the way the inflation rate is calculated is looking at the cost of things compared to where they were a year ago. Because a large chunk of this inflation is down to energy bills, we already know there was such a massive increase that we had over the last 12 months at various stages that that's already factored in. So inflation therefore will drop because although prices are still likely to go up, particularly with inflation in energy bills and elsewhere, they won't go up by as much because we've already seen such a chunky increase. So they expect inflation to start going back down. And because of that, obviously and because of the actions they say they're taking, these interest rate increases, they expect, although we're likely to have more interest rate increases over the next few months, over into next year, they expect them to peak next summer at around 4.75%. Now that is still massive. We're at 3% now. That's still a huge number of additional increases to come. But they were looking at it going above 5%. Now again, the situation is changing all the time. So just because they're predicting that's where it's going to be, it doesn't mean that will happen. It could be lower, it could be higher. But it's interesting to know that they're kind of thinking, okay, yes, we're still going to continue to make more hikes in the additional meetings. Again, roughly every 6 weeks, this happens. So I would imagine the next one, which is middle of December, we'll see another increase there, but maybe none or smaller ones will happen throughout the next year. It's still the momentum, the still outward look is to still see continued increases happening as we go through into next year. And also what they're saying is, and I mentioned this in the last update, they were saying they thought this would happen. They're saying this again. They think that the UK economy is already in recession. We haven't got the official figures for this, but they think in the third quarter of this year, so that was from July, August, September. Yeah, the third quarter, the economy did already go into negative growth, and that will continue. And they also think this will continue for potentially what will be one of the longest recessions we've ever seen, potentially 18 months, 2 years of that same thing happening, of negative growth in the economy, which is pretty seismic. Again, no confirmation of that yet, but that's what they think is happening, which is, again, partly where they're making their decisions right now. One of the things that also has kind of hamstrung them slightly is that they don't know what the new government is going to be doing. There was due to be an announcement on Monday on Halloween. That's been moved back until the 17th of November. And we'll see what Rishi Sunak, now Prime Minister, and his Chancellor, Jeremy Hunt, what they are going to do. I will obviously update you here on the channel. So if you haven't already, make sure you hit that subscribe button so you get all the videos through to your YouTube page when they are released. And we'll tell you what happens there. It may well be things that are announced there can really heavily influence that next meeting from the Bank of England in the middle of December and going forward. We'll have to wait and see there. So that's what's happened. That's where we are. Interest rate, the base interest rate is at 3%. What does this mean for your money? Now, I say often similar things every time we have an update, but I think it's important reiterating it each time we do this. And let's start off with savings. This is where an interest rate hike is good news, because although it doesn't happen to every single account, it doesn't happen necessarily the full amount, this amount of money will generally be passed on to us. Now, don't just expect to say there that the money you have right now will suddenly be earning 0.75% more than it was before. You may well have to shop around. And also, it may well be that this increase has already been priced in by some lenders, some providers, sorry. They might already have gone, right, we expect this to go up by somewhere between 0.5 percentage points and 1 percentage point. So let's just whack this as our account right now, get us to the top of the tables or near the tables, get some money in, and then we can kind of bring up the drawbridge, so to speak, so more people can't come in. We've got our money already locked in. Others might decide to start passing it on over the coming weeks. What you have to do is you just have to go and search. Now, I did a video on Sunday. Was it? What day is it today? Thursday. I did a video on Tuesday looking at the latest update on the best savings accounts. If you haven't watched that one, do check that out. And also head over to the blog, becleveryourcash.com/savings. That's my site. That is where I, on a daily basis, once or twice a day, check what are the highest rates you can get on a variety of different accounts. So you need to be actively looking about where you can put your money and the best place for them. One of the questions that often comes up when we look at this potential for future increases is, should you fix? This is a really, really hard one to answer. Rates right now for a 1 year fix around 4.6. They have peaked a little bit above that 4.65 briefly. I would expect those to increase a bit. But if they are already pricing in where they think rates will be in a year's time, it may well be that the Bank of England saying today they don't expect rates to go up as high as they initially said. We might see slower movement going on now. There will be some increase, but I don't necessarily think we'll see such the rapid rate of hikes that we've seen over the last month, because they really have moved up a lot over the last couple of months. But you never know. And that is one of the worries with fixes. You could lock into a rate right now, which seems pretty good. You're tied in for a year, maybe 2 years, maybe 3 years. But when you're locked in, that means if rates do increase elsewhere, if rates do get better, you may miss out. So that's something you've got to be comfortable with. Is this a rate that you're happy with now? You think, right, actually, no, I'm going to go for it. Or do I hang around and wait a little bit, see if they get better? Obviously, the longer you wait, your money will be losing out because it'd be sitting in a lower paying account. So it's not easy. What I would say, again, do check out my savings updates, but you can currently get 5.25% up to 5K in the Barclays Blue Rewards Rainy Day Saver accounts. You have to have a Barclays current account with Blue Rewards. All is explained over on the blog and in a previous video from about a couple of months ago. That one, 5K, if you've got 5K at 5.25%, that is going to be top of the table for a while, I would imagine. Lloyd's also giving 5.25% on a regular saver, up to £400 you can save in there every single month. You do need to have a Club Lloyd's current account. That is, going to have, for most people, going to be absolutely fine. If you have larger sums of money, then yes, absolutely, you might want to sort of think about the different options. Mortgages, though, and borrowing. Let's do mortgages first of all. The story here is, even worse than it was when I did this update 6 weeks ago, because obviously we had that absolute chaos in the mortgage markets on the back of that Liz Truss and Kwasi Kwarteng mini budget, where the mortgage rates just shot up. Things were pulled. There were less offers available for you. It was a complete nightmare. That has settled down a little bit. Things have fallen down a small amount, but they are still very, very high compared to where they were before these hikes happened a year ago. Massive, massive, massive increases. So if you are at a stage now where you're on a variable rate mortgage or you've got a fix that's coming to an end, then you are, if you want to get a new deal, it is going to be so much more expensive than what you were we're used to. However, definitely would recommend you have a look at that, you see what is out there, because if they haven't already priced this in, this increase is 0.75 percentage point increase, they will be. And again, anticipation of yet more increases to come. Sitting on a variable rate deal is going to be very, very, very expensive. It always generally is very expensive. So they are not going to be the best ones for you. If you're not sure about it, do talk to a mortgage advisor. They can give you a bit more insight into the situation. But I certainly would recommend looking for a deal. If you are currently on a fix that's got 3 to 6 months left, you're probably able to lock into a deal. It's not too late to do this right now, okay? You don't think, oh, I've missed out on those rates. So what's the point? Well, they could get higher. So see if you can lock into a rate right now. And there's no commitment yet. So it could well be that if suddenly things do change before you actually activate that remortgaged offer, things have come down, then you can look at something again. But certainly try and get yourself on a better deal right now. If you are on a tracker mortgage right now, you'll likely see that it increases tonight by that 0.75 percentage point. So that's going to be a lot of money. Again, going back to a year ago, if you want a tracker, the base rate was 0.1%, now 3% plus whatever your rate is. That is a vast increase, a lot more money that you will be spending. So although trackers have generally been quite good in the past, now they are going to be starting to get quite expensive. Doesn't mean they aren't good. They're still worth having because it might give you that flexibility if rates do start to come down. But certainly, I would definitely think about the deal. And you do also have to remember, if you're in a locked into a deal that isn't ending, whether it's a fixed rate or a tracker, whatever it might be, just check what those penalties are if you leave it early, because they could be not worth going through, cost you too much to leave that mortgage to go onto one of the new deals. So just be really, really careful there. Interestingly, when we're talking about fixes, if you are looking for a new deal right now, some of the longer term fixes might actually be cheaper than the 2 year, 5 years and 10 years, 7 years, whatever it might be. They might actually be cheaper. Now, if you are considering going for a longer fix, that might not be a bad thing. If it gives you security, if you're worried about rates going up again, if you know, right, I can at least afford this when I'm locked in at this rate and it will be cheaper than a shorter one. One thing you do need to consider though, with any kind of fix, but particularly the longer ones, is they will have those exit fees again there if you do try to leave early, if you are forced to move your house. You might not think you're going to move, but so many things come into our lives that means we have to relocate or downsize or whatever it might be. So just be extra aware that that is a condition that comes into some of those longer fixes, even if they do give you some certainty, albeit at pretty high rates right now. A lot to pack into this one. Let me know below in the comments what you think of the latest rate. How is it going to impact you? Is it good for you or is it bad for you? My name is Andy Webb. Thank you so much for watching and I will see you again very soon.